Deciding where to invest your hard-earned money in Australian property is a significant choice. It's a classic head-scratcher for many aspiring landlords and homeowners alike. Do you go for the bright lights and established convenience of a major metropolitan city, or does the burgeoning appeal and potential value of regional Australia call to you more strongly? Both paths offer unique opportunities and, of course, their own sets of challenges. Understanding these differences is absolutely crucial before you even think about signing on that dotted line. This decision isn't just about bricks and mortar, it's about your financial future and lifestyle. The allure of metro cities like Sydney, Melbourne, or Brisbane is undeniable for many. These urban centers have long been the powerhouses of the Australian economy. They typically boast strong job markets, extensive public transport, and a wealth of amenities. Think universities, major hospitals, entertainment precincts, and diverse shopping options. Historically, capital growth in these areas has been substantial, attracting investors looking for long-term appreciation. However, this popularity comes with a hefty price tag, often making entry into these markets a significant financial hurdle for new investors or first-home buyers. Affordability is a major talking point here. On the other hand, regional Australia has experienced a remarkable surge in interest over recent years. This isn't just a fleeting trend, it's a fundamental shift, driven by several factors. The pandemic certainly accelerated this, with remote work becoming more feasible for many. People started seeking more space, a different pace of life, and often better value for their money. Towns that were once considered sleepy holiday spots are now vibrant communities with growing local economies. The key here is identifying regional centers with genuine growth drivers, not just temporary appeal, ensuring your investment has legs. So, the big question remains, where is the smart money heading in 2025? Is it sticking with the tried and tested metro markets despite the high entry costs? Or is it venturing into regional areas, chasing potentially higher rental yields and a different kind of growth story? There's no single right answer for everyone, unfortunately. Your personal financial situation, your investment goals, and your risk tolerance will all play a massive part in determining the best strategy for you. We need to delve deeper into the numbers and trends to get a clearer picture of what's on offer. When we talk about financial metrics, capital growth is often the first thing that springs to mind for property investors. Metro areas have traditionally been the champions of strong, consistent capital growth over the long term. Think about the decades of price increases in prime suburbs. This is driven by high demand, limited supply, and ongoing population growth. However, the sheer cost of entry means that even a decent percentage gain might require a massive initial outlay. Affordability in cities is a real barrier, and it can limit the pool of potential buyers and tenants, which can sometimes temper that growth. Conversely, many regional markets have recently shown spectacular capital growth, sometimes even outperforming their city counterparts. This has been fueled by the exodus from cities, increased infrastructure spending in key regional hubs, and a lower starting price point. A smaller percentage gain on a more affordable property can still represent a fantastic return on investment. The trick is to find regional areas with sustainable growth drivers like new industries, improved transport links, or government investment, rather than those experiencing a temporary boom that might soon fizzle out. You need to do your homework very carefully. Recent growth trends have certainly painted an interesting picture. While some metro markets saw a slight cooling after the intense post-pandemic surge, fundamental demand keeps them resilient. Well-located properties in desirable city suburbs continue to be sought after. Projected growth for metro areas often points to steady, albeit perhaps more moderate, increases. The key indicators to watch are population growth, employment rates, and any new major infrastructure projects. These elements typically underpin sustained demand and, consequently, property value appreciation in the big smoke, ensuring a level of stability. Regional growth trends, while exciting, can be more varied. Some hotspots have seen prices skyrocket, leading to questions about whether such growth is sustainable in the medium to long term. Other regional centers are showing more steady organic growth based on genuine economic development and lifestyle appeal. For investors, this means thorough research is paramount. Look beyond the headline figures. Projected growth in strong regional centers often hinges on continued government and private investment, diversification of local economies, and the ability to attract and retain a skilled workforce for the future. Rental yields are a critical factor for investors, representing the annual return you make on your property through rent relative to its value. Generally speaking, regional areas often boast significantly higher rental yields compared to metro cities. This is primarily because property prices in regional towns tend to be lower, while rents can still be quite robust, especially in areas with strong employment or a shortage of rental accommodation. A higher rental yield means more cash flow in your pocket each month, which can be very attractive for covering mortgage payments and other expenses. In metropolitan areas, while rents can be very high in absolute terms, the much higher purchase prices often result in lower percentage yields. For example, a $1 million city apartment renting for $700 per week yields around 3.6%, whereas a $500,000 regional house renting for $500 per week yields 5.2%. This difference can be substantial. Investors in metro areas are often banking more on long-term capital growth to build wealth, sometimes accepting lower immediate cash flow. It's a trade-off, potentially less income now for a bigger sale price later. Lifestyle factors are increasingly influencing where people choose to live and consequently where savvy investors might look. Regional areas often offer a more relaxed pace of life, larger homes with more land, and a strong sense of community. For families or those seeking a tree change or sea change, this can be incredibly appealing. The rise of remote and flexible working arrangements has made this lifestyle more accessible than ever before. This shift directly impacts demand for housing in these regional towns, pushing up both rental and purchase prices in desirable locations. Metro cities, of course, offer their own distinct lifestyle advantages that continue to draw people in. Proximity to work for many industries, world-class dining and entertainment, cultural institutions, and diverse communities are huge drawcards. For young professionals, students, and those who thrive on the energy of a big city, metro living is unparalleled. These lifestyle factors create consistent demand for rental properties and support property values. The choice often comes down to personal preference and what stage of life an investor or tenant is in, making both valid choices depending on individual priorities. Infrastructure development is a massive game changer for property values, whether you're looking at a bustling city or a growing regional town. New train lines, upgraded highways, expanded hospitals, new schools, and improved digital connectivity like NBN access can all significantly boost the appeal and value of property in an area. In metro areas, major projects like new metro rail systems or airport expansions can unlock growth in previously undervalued suburbs. These improvements make areas more accessible, more livable, and therefore more desirable for people to call home or to rent within. The impact of infrastructure in regional areas can be even more pronounced. A new bypass might reduce traffic congestion and improve livability in a town center. Investment in regional airports can open up tourism and business opportunities. Upgraded health and education facilities make a regional center more attractive for families and skilled workers to relocate. When you see significant government or private sector money being poured into infrastructure in a regional area, it's often a strong signal of future growth potential for property investors who get in at the right time. It shows commitment and a vision for the future. So, considering all these factors, financial metrics, growth trends, rental yields, lifestyle, and infrastructure, where should you invest in 2025? If you have deep pockets and are primarily focused on long-term historically proven capital growth, well-chosen metro properties still hold strong appeal. The stability and consistent demand in major cities are hard to ignore, despite the higher entry costs and potentially lower rental yields. It's often seen as a safer, albeit slower path to wealth accumulation for some conservative investors. However, for those seeking stronger cash flow through higher rental yields and potentially faster capital growth in the shorter to medium term, carefully selected regional markets present compelling opportunities. The key is carefully selected. Look for regional centers with diverse economies, ongoing infrastructure investment, and sustainable population growth. The risks can be higher if a town relies on a single industry, but the rewards can also be greater. Ultimately, the smart money goes where thorough research and due diligence lead it, aligning with individual investment goals and risk appetite for the coming years.